Okay, so afternoon, everyone. Thank you for joining. My name is Tom Barlow, and I head up the commercial mortgages team here at Swoop. And I spend pretty much all day helping business owners buy the premises that they're currently renting. I'm joined by Matthew from InterBay, who's one of the lenders that we work quite closely with. So you're going to get both sides of the coin today, not just the broker's side of the story. So what we're going to walk through is very simple. Most business owners don't realise that they could afford to buy their premises. So they basically they just haven't structured it properly yet. So today is just about showing you what it actually looks like in real numbers. So I'm just going to crack on. So I always start with this because it hits quite hard. So if you're paying rent of around £3,000 a month, which is pretty typical, over 10 years that's going to cost you around £360,000, and that's just completely gone. So there's no asset, no equity, nothing to show for it. So just comparing that to owning a property, the same sort of monthly commitment, but instead you could be sitting on 150 to £200,000 of equity, and that property could be worth around £650,000 over time. So the real question becomes: are you paying for the landlord's retirement, or do you want to start paying for your own retirement? So this is where it gets a bit interesting. So because most people assume owning is massively more expensive, and it usually isn't, in a lot of cases your mortgage is actually similar or even lower than the rent you're actually paying at the moment. But the key difference is rent disappears, mortgage payments build up equity. You also get fixed costs instead of rising rent, security, so no landlords are going to be kicking you out, and long-term growth in the asset. So it's not just a financial decision, it's also a control decision for your business. So just a bit of an example, and this is a real deal that we completed on. So a client has been paying £4,200 a month in rent for 6 years. That's over £300,000 gone. We helped him buy the freehold of the exact same building, and the key bit here is his mortgage drops to £3,664 a month. So he reduced his monthly costs, so the business had more money to work with every month, and he also started building equity at the same time. So 3 years later, that property's gone up in value, and he's sitting on about £95,000 in equity. So that's the shift from expense to asset. So how does this actually happen? So it's a lot simpler than people expect. So you're either going to be buying the property that you already own, that you already run your business from, or a new one that you've looked at. So you're just identifying the property. Step two, so we'll structure the deal for you properly, and we're going to match you with the right lender for your business and the property that you're actually buying. And then step three, the mortgage replaces the rent. And that's it. And this works across pretty much any sector. So we work with retail, industrial, offices, hospitality, healthcare. I've seen everything, all of it. And one tip I always give to clients is if you buy a multi-unit property, so a property that has the bit that you're trading from and potentially another property that's next door that someone else can trade from, or a flat upstairs, you can then rent that out, and that rental boosts the income that you're getting every month and basically can start paying the mortgage for you. So lenders only really care about three things. First of all, it's affordability. So they're going to be looking at your profit. But most importantly, we add back in rent, because obviously you're not going to be paying that back anymore. So say you pay £30,000 of rent and you've made £40,000 in profit every year. That's £70,000 that I can work with, because we're not going to be paying that rent anymore. Second, the property. They want something that they can sell if they had to. So location, condition, and planning all matter to them. And then third is credit. So both personal and business credit. Nothing crazy, but it needs to be clean and explainable. There are lenders who will work with clients who have had bad credit. So if you feel like you don't think that you would be able to get a mortgage because of your credit profile, still talk to me. I'll still be able to have a look at it. Like I said, there are lenders who are very flexible on these sort of things. And then if you understand those three things, you understand how the game works, really. Matthew, do you have anything to say about that in terms of?
Yes, yeah. Good afternoon, first and foremost. Thanks for having me on. Yeah, you're right. I mean, look, the fact of the matter is, when you're looking to buy the premises that you operate your business from, all of these three things are really important to lenders. Certainly, from an InterBay perspective, of course, I can only talk to you about how we look at things. First and foremost, the business does need to be profitable, of course, because that ultimately, as Tom has already said, is what's going to be based, essentially, what we're going to base your affordability on. But also, looking at your accounts, it does provide us with a bit of an oversight into the track record of how your business has performed over time, whether it's been a bit up and down or maybe it's on an upward trend. That underwriting will pay attention to that as well. So we at InterBay would tend to ask for at least the last 2 years to get a bit of a flavour for that, as well as looking at, as well as then being able to assess your EBITDA, adding in your rent, and adding back in any depreciation as well. From an asset perspective, again, Tom's highlighted it really. It's really important for us that we're looking at the strength of the asset first and foremost, paying attention to the location, but also potential kind of alternative use in the, I'm sure, unlikely event of a repossession. I think from Interbay's perspective, we're very we've got a very broad appetite when it comes to the types of assets that we can consider. You're looking at offices, retail, warehouses, light industrial, cafes, restaurants. We can consider purpose-built student accommodation, nurseries, children's daycare, medical. We can have a look at as well. So dental practices, doctors' surgeries, and then kind of in your I suppose your beauty sector, so your beauty salons, your hairdressers, your barbers, all of those types of things can be considered at InterBay. The creditworthy piece, again, that's really important. Just as if you're applying for a residential mortgage, your credit profile is going to play a part here, both yourself as directors, but also your business. So, from our perspective, we've got certain rules in place that we need to adhere to. For example, we can't consider a case if the client has any mortgage arrears within the last 12 months prior to application, for example. And then if you're looking at things a little bit more seriously, so I suppose CCJs, defaults, those types of things. From a policy perspective, we wouldn't normally look to lend if a client has a CCJ or default registered against them within the last 3 years. But having said that, there are a few workarounds that we can look to try and implement where possible. From our perspective, we're very much a kind of a manual underwrite process. So we have and offer the ability to have the conversation with your intermediary, in this case Tom, to talk through any complexities of the deal that you're looking to place, and try and find the right ways to move forward for you that suits both us and your goals as well.
Yeah, so that is quite a key thing, is that lenders can be flexible. I think, especially in the specialist market, lenders are they understand certain situations. They'll listen to stories rather than just having a no, yes, it's sort of way of looking at things. And you mentioned it before, so we're going to talk about EBITDA. So this is where most people get it wrong, and where we add the most value to your accounts. A lot of clients think I only make £30,000 in profit, so I won't get much. But lenders don't look at just net profit. So we build the numbers properly. So we add things back in like your current rent, like I said before, depreciation, one-off costs, and corporation tax. And that suddenly then becomes £80,000 compared to the 30,000 before that we can use as an income. And that's the difference between borrowing £300,000 to borrowing £500,000. So it's a big difference. And some businesses' accounts look completely different when you structure them properly. So whenever I ask you, please, can you share your accounts with me? It's not just me being nosy, it's me actually looking at it and thinking, I might actually be able to squeeze a bit more out of here for you. So this could be probably one of the biggest mistakes we see. So people go straight to their bank when they're looking at getting a commercial mortgage, and your bank probably only has one product. We've got access to hundreds of lenders, and they all assess deals differently. So depending on who you go to, you might get 300k or 525k. And as you can see from the screen, high street banks tend to stress things a hell of a lot higher than the specialist lenders that we're talking about at the moment, challenger banks as well. So if you have a look at the screen now, you can see that a high street bank might offer you £300,000, whereas a specialist lender could offer you £525,000. and that's a £225,000 difference. So coming to us, speaking to us, rather than just going to your bank straight away, could end up making it a hell of a lot different situation, where you're not going to have to struggle to find extra money to put in as a deposit. You're not going to have to worry so much about if you can actually afford the property that you currently trade from, and having to look for elsewhere for a property. So really, speaking to me, speaking to one of the team, will be able to help you to assess whether or not that property that you're looking to purchase or currently trading from is the property that we're going to be able to get for you. And interestingly, specialist lenders are often more flexible and actually more competitive than high street banks in terms of pricing. So you may think that going to HSBC, going to Lloyds may be the best option for you, but someone like InterBay actually have more competitive rates. And like I said, we're going to be more flexible with how we get there. So quick one, but important. Just explain the difference between freehold and leaseholds. So freehold of a property, I would always suggest is a much nicer thing to have purchased than the leasehold of a property. So if you can buy freehold, always do it. It's cleaner, easier to finance, and it holds a lot more value in the long term. The leasehold can work out, but you need to look at quite a lot of things. So you need to enough term left on the actual lease, and the lease needs to be lender friendly as well. If it's a short term lease or it has bad terms, it can kill a deal completely. I mean, Matt, I'm sure you have a lot to say about that.
Yeah, of course. Yeah, look, I mean, it's all circumstantial to a degree. It depends on what's available to you when you're looking to purchase the asset that you're currently trading from. I mean, realistically, the overall view here really is that securing the freehold, if that's an option, will provide you with better long-term stability, given that you own the land and the building, and essentially over time you will benefit from any increase in the asset value over time, as Tom already mentioned on one of the earlier slides. Plus, the other aspect to that is that you would have secured the location for your business for essentially an indefinite period of time, which obviously is a real positive. With the leasehold lending, again, that might be the option that's available to you. It's not a bad option. It's just, there's different I suppose outcomes for you in that regard when it comes to lending. The lease length, as Tom's mentioned already, that can affect mortgageability, given that lenders will usually want a minimum unexpired term on that lease at the end of your mortgage term itself. So for InterBay, as an example for us, we can lend on a leasehold commercial unit. But we do require the leasehold to have a minimum of 50 years unexpired remaining at the end of your mortgage term. So to put that in easy terms, our maximum mortgage term is 35 years. So for that to qualify, your lease would have to have a minimum 85 years remaining at application for that to be acceptable to InterBay, for example. And then, of course, leasehold, I suppose the value of the asset will naturally decline over time as the lease shortens. So that's something to bear in mind as well. One thing I would point out though, and every lender is different, so that's the key caveat here, but InterBay, from our lending perspective, we can lend up to 75% loan to value, and that isn't affected by whether the asset is freehold or leasehold. It doesn't matter, as long as it works on the numbers, then we can support you up to 75% loan to value. So I just thought I'd mention that at this point.
So now I just want to talk a bit about deposits. So most people think, I don't have enough deposit, so I can't do this. And that sometimes isn't true. So deposits can come from retained profits, refinancing another property. So say you own a buy-to-let property, or even on your residential home. So we can look to do a second charge on the residential or completely remortgage it, just to draw out some extra funds from there. So I'll always look at all options for you. Family support. So we can always accept a gift as a deposit from family members, or a mix of all three. I've managed to find deposits from here, there, and everywhere for clients before, just to get things to work for them. Obviously, if it's going to put you under financial stress, I would never suggest it. But if it's something that works, and obviously it's going to benefit your business and you're going to grow the business from it, then obviously it's a good idea at the end of the day. And typically you're going to be looking for at least 25%, but sometimes 30% deposit. And obviously then costs on top of that. And the key is structuring it properly and evidencing it early. So they're always going to be looking for a trail of where that deposit is coming from. Matthew, I'm sure you'll be able to say that exactly.
Yeah.
Gone.
Absolutely. You know, it's one thing to kind of say to a lender that I've got money in a savings account, but the lender will still need to understand how that savings account is being built up over time, because they want to make sure that the origination of the funds into that account is something that they can accept. So, you know, and that'll be true, you know, of a family gift, for example. You know, gifted family deposit is widely accepted across most lenders, InterBay included, but there may still be some kind of review into how did the family member gifting you that deposit, you know, build up those deposit funds essentially. So it's always about being able to trail that all the way back to origination to make sure that the lenders are okay there. And most of the time, the solicitors will do that as part of the legal phase. Like I say, we can accept family gift as a deposit at InterBay. Needs to be a close family member, so spouse, parents, children, siblings, grandparent, aunts and uncles, those types of things is generally fine. If it's kind of a more distant family member, you might find that you struggle a little bit more there. But again, your broker, and again in this case Tom, will be able to talk you through that and liaise with the lenders directly and appropriately. We'll also accept your kind of your business profits, so directors' loans, intercompany loans. They're both accepted at InterBay, subject to qualifying criteria. So with your directors' loans, the purchase price will need to be at full market value to ensure that any and all tax liabilities are paid in full. The individual providing the director loan must be a shareholder within the business as well. Intercompany loan, that's again considered at InterBay. The majority shareholder will need to mirror across your SPV, so the borrowing entity, and the connected company, and it must be a UK to UK company transaction, so no offshore companies. That's an InterBay policy. It's not to say other lenders wouldn't be more open to maybe offshore arrangements, but for us it's UK based. But look, essentially, as long as we can track the deposit, we can have the conversation about you and see if we can get comfortable with the deposit for you. I suppose a couple of things to call out that wouldn't be acceptable as a source of deposit from an InterBay perspective would be cryptocurrency or gifts outside of the kind of the previously mentioned parameters. So things whereby it's maybe someone's lending you the money, that's not generally accepted, whether that's from a family member and expect you to pay that back. The key thing is it has to be a gift. Similarly, we wouldn't accept a personal loan or business bank loan, for example, as a source of deposit at InterBay.
Yeah, and that's true. Not across the board. There are some lenders who will accept it. I think one key thing to say about that kind of thing is when you get into a more risky type of deposit or any sort of risk within any of the property, your credit profile, anything really, the rates will be going up. So with risk comes higher price, basically, is what I'm saying there. I have had deposits come from all over the world. I had one recently where the father had died in Jordan. The money then travelled from Jordan to Iraq and then to the UK. But because we were able to evidence where that money had come from, we were able to use it as a deposit. So like I said, as long as you can evidence where that money is coming from, and same as what Matthew's just said, the lenders will be able to have a look at it and say, consider it for a deposit. Just moving on now. So this is more of a structuring point, but it's quite a powerful one. So we often split things into two companies when businesses are buying their property that they're trading from. So one owns the property, and that's the PropCo, and one runs the business, and that's the OpCo. And now a lot of people ask why. It's because it protects the asset. So if the trading business hits trouble, the property is ring fenced and it is still yours. And it also gives you flexibility long term. So whether that's selling the business or keeping the property as an investment in the future. So say you wanted to retire in 20 years' time, you still own that property, you can close down the business, you own the property in a different business, and you can start trading as just a rental company and renting it out. And then again, that then is another thing saying that's paying for your retirement. Obviously, you could sell the property in 20 years' time, having paid off the mortgage, but in 20 years' time, God knows where rents are going to be. So you could be getting yourself £5,000 a month from just having this property that you've already gotten all your money's worth out of because you've traded your business from there for 20 years. So OpCo, PropCo is what it's called. A lot of people will do it. Your accountants will probably talk to you about it as well. I won't go into it, but there probably for yourselves will be a lot of tax benefits from doing it as well. But yeah, so very much something that we do quite often. And now just going on to the the four killer things that we see most often. So, as I mentioned before, going straight to your bank. So your bank will offer one product, whereas if you come to us, we can access hundreds of products and with different lenders who accept different things. For getting costs like stamp duty. So a lot of the time when I talk to clients, they come to me and they say, I've got the 25% deposit. And I say, brilliant. And then we start talking, and then all of a sudden I say, well, have you got any money for the stamp duty? Have you got money for legal fees? Have you got money for X, Y, and Z? And they say, oh no, I thought I only needed the 25% deposit. So making sure that you've got the funds in place, not just for the deposit, but also for things like stamp duty. Like I said, if you go on the government website and you type in what you're looking to buy and how much you're purchasing for, it will calculate how much your stamp duty will be, or just speak to your accountant, obviously. Valuations is another fee that a lot of people forget about. Typically on a commercial property, you're looking at about £1,500 to £2,000 on a commercial valuation. A lot of people gasp at that, but if you see the reports when they come back, they're about 90 pages long, so that you get your money's worth from them, trust me. Not checking planning consent. So a lot of the time when you are in a property, you don't really have to think about these kind of things, but when you actually go to purchase it and it gets to the legal stages, they're going to be looking at the planning consent on the property, and I'll even check it before that because I know that it falls down quite easily on this moment. But say that you've got a property that you've been trading as, I don't know, a bakery, but it actually has use for something completely different, but your landlord's just been letting you do it and no one said anything for years. If you then go to purchase that property and you say to a lender that I'm going to be running it as a bakery, they'll turn around and say, well, you don't have a legal right to do that anymore, so we can't lend on that. So just checking your planning permissions on your property is a major thing. And then showing weak accounts without an explanation. So if, for example, you've had 5 years of really good trading and then 1 year it just drops. Like I had one yesterday where clients come to me and said, my accounts don't look that good last year, but I was really ill. I was redoing my house, so I didn't put as much effort into the business as I should have done. Well, that's a good explanation as to why your accounts had fallen down. If I go to a lender and I say to them that this is the reason why they've gone down, these are the projections for the next year, they're going back up to where they were before, there's an explanation behind it, and a lender will take a look at it. None of these are deal breakers on their own, but unmanaged, they will slow down or get a decline eventually. So it's just something that you have to consider when you're actually looking at doing this.
Yeah, I think one of the important ones from our perspective is the accounts and how they're presented when they're presented. You know, if you're showing a loss in one of your most recent years, that doesn't necessarily mean the lender won't lend. It's just that they need to understand why there was that loss. They need to understand, you know, what were the mitigating circumstances around that, or and really just to identify that was a one-off and it's not a kind of an ongoing trend that is going to cause concern, because naturally we have to apply our risk appetites. We need to look after you as the borrower and also ourselves as the lender. So we need to be responsible. So yeah, I think Tom is absolutely right. It's always best to provide the accounts with some rationale if there is anything on there that could cause a query or a concern from a lender's perspective. And look, from InterBay's perspective, whilst we won't assess accounts pre-underwrite as such, so before the application, Tom and I, to use Tom as the example, we can have a chat about the accounts and we can run it past an underwriter before an agreement in principle is key, just to get a bit of a sense check that we're happy with how the accounts generally look without going into too much detail on them, but also we're happy with the explanation, so that subject to full underwrite, we're pretty confident that we should be okay with the information that's been supplied.
Yeah, exactly. And sometimes even just a letter from your accountant as well can suffice as a bit of evidence to say this is what has happened. So your accountant is also a very useful person to have at this stage.
Agreed.
Right, so just a bit about how long it takes. So people always do think that these things take ages, but in reality, it's usually around 8 to 12 weeks. And the biggest delays are almost always the legal stage. So the earlier you get organised, the smoother this becomes. So as you can see here, so discovery call with us. So I'll review your deal, structure your EBITDA case, and identify the right lender. Then do an application with the lender and get an agreement in principle. And then it goes to evaluation. And then once the valuations come back, it will go to a formal offer from the lender. And then it goes to the legal stage. Now, one thing that I will say about the legal stage is a lot of people will come to me with a solicitor that they've already appointed themselves. Lenders will have a panel of solicitors that they'll accept, or at least have a standard that they'll accept as solicitors. So don't go paying out for a solicitor before you've spoken to me about which solicitor you're going to be using, because I've had people pay for solicitors before and then me have to turn around and say, look, I'm really sorry, but you can't use them. Same with evaluation. So a lot of lenders will use VAS panel, the biggest panel in the UK for surveyors. So don't just go out and get your own valuation. Like I said, they can be quite expensive. And if you get one done and I send it over to a lender and they say, we can't use this, I'm sorry, we're going to have to get another one done. You'll be paying twice for it. Every lender as well will ask for it to be written slightly differently. They'll be looking for something different in the valuations. So, if I go to InterBay, for example, they could be looking for something completely different to if I went to Shawbrook Bank or Together. Then it means that if you've had that valuation done for that lender and we end up having to go to another lender, we may well have to then get a retype on it as well. So what will I need when you come to me? So if you think about doing this, there are a few key things that we'll need. So like we've discussed many times, your accounts, bank statements. So typically lenders ask for about 6 months worth of your bank statements. Some lenders ask for 12 months, some lenders ask for 3 months. But if you send me over your 6-month bank statements for both your business and your personal, I need the property details. So I need at least an address. If you're buying it on the market and it's got a Rightmove link, that would be really useful. If not, I can always look it up otherwise. So just going on Google Maps and have a look at there, really useful. And like I said, deposit evidence from before. So just where you're going to be getting that deposit from at the start will evidence it further down the line, but just telling me where you're actually getting that money from. There's nothing unusual. Just getting it ready early makes a big difference. So if I have everything up front, I can go to a lender and get answers quite quickly. Whereas if you give me bits and pieces, not everything, I'll go to a lender and I can get a yes up front. They'll come back to me with a few questions. We'll go down the line a little bit. And then when they ask for something that we could have had up front later down the line and it doesn't actually fit with them, that means we've wasted our time, wasted your time. Whereas we could have had everything up front and managed to get an answer straight away. So just getting yourself ready is really important for these sort of things. So just to wrap this up, most businesses are already paying enough in rent to own their premises. They haven't structured it correctly or spoken to the right people yet. If this is something that you're even considering, the next step is just literally giving me a quick call. I'll tell you very quickly if it's doable, how much you'll be able to borrow, and what it could look like for you. It's no pressure whatsoever. It's just clarity on it. And obviously we're not going to charge you anything for just having a conversation with me. I'll help you as much as I can, just to give you an idea. And I'll tell you if I think it's not going to be doable, and I'll give you the explanation as to why, and also what you can do to get yourself into a position where we will be ready to get you a mortgage eventually. Yeah, like I said, the next step is just a 20-minute call. Just as a reminder to everyone, we've got another webinar coming up soon on how to fund business growth without destroying your cash flow. That'll be on the 15th of April with my colleague Connor. But for now, thank you everyone for coming. Thank you for joining. Thank you, Matthew.
Thanks for having me.
I hope you've all learned everything. Let me know if you've got any questions in the future. I'm just a call away. All right, thank you everyone.